All right, so I guess we'll get started. Thank you everybody for coming to our next, I guess, installment covering some of the financial relief programs under the CARES Act. Just before we get started, just want to highlight copies of our presentation and all of our other resources can be found on our website. Our presentation is based on all information current as of April 27th, 2020. Any key changes that may occur after this or may have occurred this morning may not be reflected in this presentation. The information that we are providing here is based on our interpretation of the CARES Act after reviewing the law and consulting with other professional sources. The webinar we're providing is for informational and educational purposes only and cannot be used to contest any IRS, SBA, or any other penalties or assessments. We cannot make any guarantees regarding your eligibility for these programs or any of the related benefits. Time permitting, we will make every effort to answer questions at the end of the webinar, and we thank you once again for your attendance. So today we're going to go beyond PPP, some alternative financial relief options, and also briefly go over a PPP update at the end of this webinar. Just some additional information we have found throughout our journeys. As many people probably know, the program is rapidly evolving and changing, and we just wanted to share a couple quick updates on that as well. So start off with my typical 30 seconds of shameless self-promotion. My name is Ed McWilliams. I am a tax director at Cerini and Associates. My specific industry expertise includes healthcare, financial services, technology, professional services, state and local taxation, and international tax. And my contact information can be found right here as well as on our website. So to start our program today, we're going to first go over the employee retention tax credit. Basically, just to give you a high level sense, we have 4 separate programs we're going to be covering today, some in more detail than others, largely because of the nature of the programs and the type of relief they provide and the information that's currently available on them. So we'll be going over the employee retention tax credit, the payroll tax deferral as allowable under the CARES Act. We will be going over economic injury disaster loans, EIDLs, and we'll be going over the Main Street lending program. So the first one, and I think the one that probably is the most complex of the ones that we're going to go over, is the employee retention tax credit, or the ERTC. So if anywhere you see ERTC, that refers to the employee retention tax credit. I kind of get lazy sometimes and don't like to write the whole thing out. So the employee retention tax credit is technically new for 2020 and only available through December 31st, 2020. There have been very, very similar programs in the past for certain federal disasters. I want to say during Hurricane Katrina, they enacted a similar program down in the Gulf area. However, the execution of that program was more similar to a work opportunity tax credit where you claimed it on your income tax return rather than the ERTC, which is a tax credit against your payroll taxes. The ERTC is open to eligible employers who pay qualified wages during the period the credit is available. I will be going over both who is an eligible employer and what qualified wages are. The credit itself is for up to $5,000 per employee for $10,000 of qualified wages. That is a annual limit, not a per quarter limit. There was some hope and or misinterpretation when the program first got launched that this credit would be quarterly because there was a reference to certain quarters within the code. However, the IRS has clarified that that is an annual limitation. So you can get a 50% credit for up to $10,000 of qualified wages, and that's a per employee credit. Off of the bat, I just want to hit on a very high level that you cannot claim both a PPP loan and an employee retention tax credit. So anyone that currently has a PPP loan in process, you are not eligible to claim this credit. This credit can be used, however, by businesses or organizations that were unable to apply for a PPP because of affiliation problems. They were unable to meet the economic needs certification, or they were unfortunately unable to get one during the first round and may not be able to get one during the second round as well. So this is an alternative program, not an additional program. So it's very important to keep that in mind. So on a real high level, calculating the employee retention tax credit is not particularly difficult or burdensome. You first determine if you are an eligible employer. You then calculate your qualified wages, and finally, you will claim your tax credit. Seems kind of straightforward from a tax perspective, right? You know, most tax stuff we think about is complex and overly thick and a bunch of forms. They made this somewhat simple, but there's some nuance to it, and we need to just make sure that we navigate around that accordingly. But it's really pretty much a three-step process: determining if you're an eligible employer, calculating those qualified wages, and then finally actually claiming the credit. So let's first go over who is an eligible employer. So under the ERTC, an eligible employer is an employer that meets one of the two following scenarios. They have either fully or partially suspended operations in any calendar quarter due to a governmental authority limiting commerce, travel, or meeting due to coronavirus, or have experienced a significant decline in gross receipts in the same versus the same calendar quarter in the prior year. A significant decline is meaning less than 50% of your gross receipts than in the prior year calendar quarter. So a couple things I want to hit on when it comes to the first item. Fully and partially suspended hasn't been as strongly defined as we would hope. Right now, the only guidance the IRS has given to professionals and people who wish to claim this credit is in the case of a restaurant. A restaurant that is unable to provide dine-in service but is able to provide takeout service is considered partially suspended. So that's the only real guidance we have to go off of on a partial suspension. We are assisting several clients with these tax credits and have set up kind of a conservative framework thinking about, are employees eligible to telework? Are there services for them to provide? Looking at it really on a department by department, circumstance by circumstance scenario as to determine what is fully or partially suspended. I think about myself as an accountant. Right now, I am comfortably working from home, have been since middle of March. While I'm working at home, I don't have access to the same level of resources I may in the office. We are using VPNs to connect to our softwares and databases. The collaborative environment probably isn't as strong just because we're not in a face-to-face scenario. And my couch and television aren't 50 feet or less than 50, I would say, are not 20 feet away from my workspace like they are at home. So while I could say maybe I'm partially suspended because I'm unable to go to the office, I would say, given the full facts and circumstances, that I probably don't qualify for this as an accountant because I am able to substantially perform all of the services that I am able to in the office. Maybe I have a little bit of a loss of efficiency, but I think in the spirit of what they're looking to do, we wouldn't qualify for that. So that's why we're really looking at that fully or partially suspended in a more facts and circumstances bespoke manner, just because there is no bright line of saying if you can only work X hours or if then. It really needs to be in light of the full circumstances that exist for every individual employer. I just want to note that for any nonprofit organizations, only the first item is what you would use to determine if you are an eligible employer. The second item, the significant decline in gross receipts, is not used in determining if a nonprofit organization or a tax-exempt organization is an eligible employer. So just keep that in mind if you are looking to potentially claim this, that there are some different standards. The key one being the test a nonprofit would use in order to determine if they are an eligible employer. Okay, so now that we've kind of hit on whom an eligible employer may be, again, for most people, I think it's going to be subject to that full or partial suspension. There's now going to be a question of what are qualified wages. So qualified wages have two levels of testing. Depends if you have less than 100 employees or more than 100 employees. In the event you have less than 100 employees, it's very simple. All wages you paid to any employee as an eligible employer are considered qualified wages. So if I take an example of a restaurant that is unable to provide dine-in service, but is able to provide takeout and has 60 employees, they would meet the partially suspended test under the IRS guidelines, and they have less than 100 employees. So that means they are able to claim this credit up to $10,000 of qualified wages for a $5,000 credit for all employees because they have less than 100 employees. In the event your organization has more than 100 employees, only wages paid to any employee not providing services under either economic hardship criteria count as qualified wages. Important to note that not unlike the PPP qualifications, but under a different, more fact-based set of rules, there is not what's called affiliation, but what the tax code calls attribution, meaning that you can have under a controlled group of companies, such as if you have common ownership or a parent subsidiary relationship, be considered to be one employer under tax code law, and as a result be over the threshold. So I'll take a very simple example. I happen to own, and I actually don't, but if I happen to own, let's say, 3 separate businesses, one has 25 employees, one has 70 employees, and one has 50 employees. Well, individually, each one of those are less than 100 employees. However, under tax law, they are what are considered brother-sister organizations. Therefore, they are under a common control and ownership, me, and now I am considered one employer for the purposes of calculating my number of employees, and I now have to qualify for the more than 100 employee test, even though each one of those organizations individually do not have more than 100 employees. So when we talk qualified wages, we are talking wages paid between March 12th, 2020 and December 31st, 2020. Qualified wages means any form of compensation plus any health benefits paid by the company. So it has a pretty broad definition. Basically, it's what you're paying someone for payroll during the period of March 12th, 2020 to December 31st, 2020. Today is April 28th. So, as you may note, there is a good chance that you have already paid qualified wages depending on the facts and circumstances of your organization. So, your first claims can be happening now. You would not claim it on your first quarter 2020 returns, even though you may have paid qualified wages during March 2020. So there was some concern by some people I have spoken with that they would have to rush to get this claim in before filing their first quarter 2020 payroll tax return. However, that is not the case. You can make the claim for any first quarter 2020 wages on your second quarter 2020 payroll tax return. So we've now covered really what an eligible employer is and what qualifying wages are. And I will go through some simple examples on that stuff in a few moments. But finally, we now get to actually claiming the employee retention tax credit. So your first step is going to be to calculate your appropriate credit using the guidelines of, am I an eligible employer? Have I paid qualifying wages? How much are my qualifying wages? And using the credit rate. Once you know how much your credit is, you will then reduce your upcoming payroll tax deposit by any credits that you are eligible for in the following order. You will first reduce your employer share of Social Security. You would next reduce your employer share of Medicare tax, and then you would reduce your employee withholdings. Now, if you note, next to employer Social Security, you have a bright letter A. So one of the items we're going to be covering next is a payroll tax deferral, which is allowed under the CARES Act. So in the case someone takes advantage of the payroll tax deferral, the IRS has said the order of operations is you may first do the deferral and then claim the credit. So even though your credit is against the employer's Social Security, you can defer that and then dip into Tier 2 and Tier 3. Why that matters is it may allow you to access more liquidity by having less payroll tax deposits and a higher level of refundable credit, because you can first make the deferral through December 31st, 2020, not having to be paid for 50% for 1 year, 50% for the next year, which we'll go over, but it is a taxpayer beneficial item. There is a pecking order, and it was a taxpayer beneficial one. The credit itself is fully refundable, meaning any amount above your payroll tax deposit will be eligible for a payment from the IRS. You may have heard that as of last week, the IRS was not accepting any paper filings, and they basically had no staff. They started to staff their service centers back up yesterday on a voluntary basis. I've read some political discourse on this action today, so we'll see how that stands. But as of today, the IRS does have more people in their service centers. Even so, in order to facilitate these claims, the IRS was allowing the Form 7200, which you use to claim the credit if you have an overpayment, to be faxed to a service center to allow people to get the payment faster. I have heard hearsay that these payments were not going out as well as they would want, but they at least did make an effort to get those. So again, your credit is fully refundable, which means that any amount above those payroll tax deposits you can get the advance payment for, and they are working to try to make you get that as fast as possible. Who knows if it's actually working or not, though. So first, I want to just do a quick example on the significant decline, just so we can examine what the statute says right now. So in my first example, I have my gross receipts in 2019, and then my gross receipts in 2020. So for 2019, pretty simple example, I did 2.5 million every quarter for all 4 quarters for a total of $10 million in sales. In my first quarter of 2020, I had a 60% decline, or I am 40% of my prior quarter, which means I have entered into a period of significant decline. I stay in my period of significant decline until my receipts are greater than 80% of my prior year quarter, and only for the quarter after that event occurs. So if you look in the first quarter of 2020, I had a 60% decline, so I have 40%. In my second quarter, I had an 80% decline, and I'm only 20% of my prior quarter. So in both cases, I'm still above the 50% threshold. My third quarter of 2020, I still have a 25% decline, but I'm starting to see a recovery. I am still in a phase of significant decline. my fourth quarter of 2020, I have more or less fully recovered under the facts and circumstances, showing only an 8% decline. However, I'm still considered in the period of significant decline for that quarter. It would only end on the quarter after, which would theoretically be first quarter 2021, which is when the period would end anyway. So under this example, even though in the fourth quarter, I managed to get above that 80% threshold, I still am able to claim this credit under the significant decline criteria. Let's look at a second example. So same 2019 baseline sales. Luckily, my first quarter 2020 only, and I can't believe I'm saying a 12% decline isn't bad, but only showed a 12% decline in sales versus my prior quarter in the prior year. So I am not in a period of significant decline. However, in my second quarter, I had a lot of trouble, which I think we're going to see as a common fact pattern based on when the shutdown occurred and the prolonging of said shutdown, that I am at a 56% decline and only 44% of my prior quarter. So I have now entered that significant decline. I happened to bounce back in my third quarter and go to a only 8% decline. I must have had a rapid recovery. I'm still an eligible employer under the significant decline in the third quarter because it's only the first quarter after I eclipse 80% of my prior year that I have to now no longer consider myself an eligible employer. So that means in fourth quarter 2020, I am no longer an eligible employer. So what I was trying to stress there is it's based on the first quarter after you meet the no longer significantly declined scenario. When we talk about gross receipts, they are generally talking about the method that you use for your federal income tax accounting. So whether you're cash or accrual on your tax return would be the method of how you would calculate those gross receipts. So now let us look at a ERTC example right here. So a state has issued a pause, similar to New York, order or a safer at home order, and as a result, a non-essential business has been closed. So we are seeing that we are meeting the shutdown scenario by a government authority. I have 4 employees in my current example, A, B, C, and D. They are in sales, service, administration, and the president. So on a real high level, the first thing I want to take a look at is, are they able to telework? So my sales and service people are unable to telework under my business model. My administration and my president are able to telework under my business model. Is there any work available? For sales and service, they can't telework, so they have no work available. Under my business, my administration staff doesn't really have anything that they can do. Most of their tasks are in-office related items that can not really be done. And as a result of the shutdown, I just don't have anything for them to do. However, the president is still able to work as he is still trying to work on other business related items, maybe trying to do continuity plans, doing potential sales or growth or whatever it is. So we're considering the president is able to work remotely and he has work available. I have run 3 payrolls, April 3rd, April 10th, and now on April 17th. These wages are based off of their entire year. I pay on a per weekly basis. So I'm keeping everybody on payroll on my business because I think about how hard it was for me to get this talent in the first place. And as a result, I don't want to let them go. I know it feels like forever ago because when I was rereading the timeline of events to when the shutdown happened, it happened a lot faster than we all remember because every day feels like it's a week. But if you really look, we went from everything's fine to don't go anywhere in a matter of about 8 days. But where I was going with this is think back to January 2020, December 2019. And one of the hot topics that we were talking about continually was the challenge of finding talent. It was a hot marketplace for workers. Very difficult to find employees that were talented, just even to hire. So as a business person, I'm saying to myself, I have a great staff. I want to try to keep them on payroll as long as possible, even if I can't get this PPP, because I think long-term I need it for my business. So that's the reason why he's doing this. I have these 3 payrolls for total wages of $4,327 for employee A, $2,596 for employee B, $3,000 for employee C, and $10,500 for employee D. So now let me look at my qualifying wage maximum. So for employees A, B, and C, they are below 10,000. So all of their wages are theoretically under the maximum for qualifying wages. For employee D, he is $500 over. So his qualifying wage maximum is 10,000. So I have a total of 19,923 of potential qualifying wages. Finally, I take a look at all the facts and circumstances, particularly here, the ability to telework and is work available, and I make a determination. Are these employees able to provide service? A, B, and C are unable to provide services. D is able to provide services. If my organization has less than 100 employees, my qualifying wages are all wages that I paid, or 19,923. I have a 50% credit rate, meaning I have earned a credit of $9,962 under the employee retention tax credit. However, if I had an organization with more than 100 employees, or as a result of attribution, I'm deemed to have over 100 employees, my qualifying wages would only be $9,923 because I would have to exclude the president, as he is currently able to provide services under my examination framework that I have developed above, meaning that my credit is now reduced by $5,000 at that same 50% rate. So the example here is I have someone that provides services. If I have less than 100, everybody's good. More than 100, I have to exclude that employee who provides services at this point in time. So now let's go over claiming the actual credit itself. If I have less than 100 employees, I have a payroll tax deposit for my April 17th payroll that is due on April 20th, 2020. So 3 business days after my payroll was run. This may or may not be a weekend. I think it was a Monday actually, but kind of irregardless to this statement here. I have the following payroll tax liabilities. I withheld $2,500 from my employees for federal income tax. I withheld $1,266 and $296 for employee Social Security and Medicare, and the same amount for employer Social Security and Medicare, giving me a total tax deposit I or my payroll processor would have to make of $5,625. It's the same example for how much tax I had to deposit on both sides of the coin. So I now say if I had less than 100 employees, my employee retention tax credit was $9,962, meaning I can retain my full $5,625,000 deposit. I would not have to make that deposit, and I can request an advance credit payment of $4,337 on Form 7200, meaning giving me a $0 net payment of tax, and I can expect payment according to IRS guidelines within 2 weeks, probably a little longer, but that's what they say, if I'm able to claim that full credit because I have less than 100 employees. Now let's look with more than 100 employees. Again, same amount of payroll taxes that were potentially due. However, my employee retention tax credit is only $4,962, meaning I can retain that amount and make a tax payment of $663. So I have no advance payment there, but I didn't have to make as big of a federal tax deposit as I would have otherwise as a result of the employee retention tax credit. Finally, I just want to go over briefly some best practices when it comes to documenting the employee retention tax credit. For many organizations that were unable to get the PPP, this provides a welcome valve of relief. Not nearly as robust as the PPP, but I mean, if you think about an organization that has 20 employees at $5,000 potentially an employee, that's a $100,000 tax credit that you're going to be claiming. If you're going to be claiming something like that, you're going to want to have a decent level of documentation. So I drew on my experience working in the international tax arena, thinking about what they like to see in those examinations, and came up with this framework. I'm going a little bit on a Boy Scout level here of this may be overkill, maybe more than you need. But the cost benefit analysis is pretty simple. If you document more than you need and you have it, great. Nothing to really worry about. All you did was waste some time, or waste some of my time if you engage us to assist. And we still have it in place. And I found that that document has been helpful for businesses looking at other items of their operations to help provide an outside analysis of certain items that just naturally occurs during the process. The flip side of the coin is you have lax documentation or not enough, and now that credit that you used, that you may have used to help keep your business on life support, you may have to pay that back and may not be eligible for it. And that is just I go non-starter would be the term I would use for a lot of businesses. So I think having a strong level of documentation here is going to be crucial considering what is going on. They do impose a documentation requirement. However, they have not enumerated very much as to what they're looking for. So this to me is going to be what I think the best practice is. You would first want to give a background of the organization, including information on key revenue or support streams, how your revenue is earned, and a breakout of your functional departments, meaning sales, service, HR, so on and so forth, on a high level. I try to keep those breakout of departments, I have a top level and a subtype. I try to keep the departments into 3 to 4 to 5 areas at most. I want real high level there just to give a background of the organization. Next, giving a identification and background on the government shutdown. So in New York, we have New York on pause, and you can pretty easily search for news articles and or the governor's executive orders and really see a timeline of when everything happened. And that's what I was hinting at before, that in real time, every day felt like it took forever. But when you look back on it, it was a period of 8 to 10 days that we went from nothing is wrong to we can't go anywhere. So it happened with lightning speed. New York on pause took effect as of March 22nd at 8 p.m., which was a Sunday night, I believe. So you kind of have a drop dead date, but you should definitely document what is happening locally to you that makes this full or partial shutdown. Even if you're claiming only a 50% reduction hardship criteria, you're still going to want to do this part of it, because I think it helps talk about how that reduction came to be, rather than just maybe business isn't good or your product demand has gone down from other organic reasons. Next, you wanted to identify how this shutdown impacts your organization. For any employees that are unable to provide services, we recommend you include their name, title, their annual rate of pay, what services they are providing to the organization, why services are unable to be provided, and any alternatives considered. So if you look at my prior calculation, I touched on some of these alternatives. Are they able to telework? Am I able to have them do training or other administrative stuff? One thing I've been stressing to a lot of clients as I speak with them, both on this and PPP stuff, is this is a great time to work on the if I only had time list. So often when we meet with our clients, there's a bunch of great ideas that come from our meetings, but then there's always yeah, I would do that if I had time. If. Well, take this threat that is COVID-19 and turn it into an opportunity for your business or your organization, and try to get some of those things that are on the if I only had time pile done. Great time to rework your marketing plans. Great time to think about your office processes and how you can rework them. In my personal case, I'm terrible at filing things. So great time to make sure your files are up to date. Use this time as something to help your business if you can, rather than just sitting around waiting for the next thing to come. So keep that in mind. And that's, when I think about alternatives, can I find other things for employees to do? You just want to show that you've exhausted all ideas here and you're not just trying to claim a free handout. Even if you're not claiming a 50% decline, I would recommend a calculation of your 2019 versus 2020 receipts per calendar quarter. As of right now, we have one quarter done, so not particularly difficult. A summary calculation of any employee retention tax credit, and you also want to keep within your file, in a separate file, any documentation of any retained employer tax deposits or Form 7200. So those are your organization level documents. On the employee level, on how you actually claimed it, you're going to want to go over a calculation of wages, any qualified health plan expenses. Those are your two items for your qualified wages, and you'll want to keep payroll journals and the health invoices as your source documentation. You want to have these available in a complete file so that if somebody comes and takes a look, you have a very clean and simple way of saying, hey, I documented my decision, here's my proof of everything, and you can very easily move along and finish up any sort of inquiry from a government authority. Okay, so now that we've covered the ERTC, which is the headiest of these, normally, you think about a leadoff hitter to set the table and so on and so forth. I dove straight into what I think is the most complex of the bunch right here. Let's now go into the payroll tax deferral, which is shockingly maybe the easiest of the bunch. So the CARES Act allows for a payroll tax deferral, which allows employers to defer but not eliminate the employer share of Social Security, so which would be 6.2% of wages up to the 2020 limit of $137,700 per employee. Of the deferred amount, you will owe 50% on December 31st, 2021, 50% on December 31st, 2022. How you're going to mechanically pay that is still, I think, an open point, but it's an open point for pretty far in the future right now. I am fairly confident, having spoken with payroll processing agents, Paychex ADP, that they will be able to assist. If not, doing an EFTPS is not particularly the hardest thing in the world to set up. So we're not as concerned about how you're going to pay it, but just to keep track of when the due dates are. You're eligible for deferment starting from March 27th, 2020 through December 31st, 2021. So once again, you're already a month into when you were eligible to defer. Anything you've paid, unfortunately, you're not going to be able to get back, but something to start thinking about. And why do you want to do this? Because it provides a short-term interest-free liquidity for your organization. There's no penalties and interest, and they are foregoing expenses you would have had to pay now that you will have to pay in the future, which is basically kind of like a loan, but there's no interest or penalty. So it's a short-term interest-free liquidity option. One thing that has come up is you cannot defer while you have a PPP forgiven, but you can defer while you are waiting and using the PPP. Keep that in mind, that If you turn the valve off, to use the terms of Governor Cuomo, you'll have to open it back up once your PPP is forgiven. You don't want to forget to do that, because if you do, you're going to start racking up interest and penalties very, very quickly. So on a broad-based piece of advice, I'm not emailing out all of our clients and contacts saying to do this. I think it's a case-by-case scenario that you need to make sure that you have proper systems and controls in place, that once you are in the forgiveness of your PPP, you make sure to turn the payroll tax deposits back on. This will be done via a request from your payroll processor, ADP or Paychex. I have an example of the ADP one. It's actually pretty simple. So for ADP, you log on to your ADP website. You go into the support tab. It will have an area that says COVID-19 Social Security Tax Deferral. You enter your service center, your payroll code, you hit next twice, and that is it. That completes the deferral request. If you're not sure how to do it, reach out to whomever your specialist is, and they'll be able to help you. So for other platforms as well, reach out to your specialist. But I wanted to demonstrate that on ADP, who, maybe the kings of paperwork, the process was all of 5 minutes. And I think 2 of those were logging in. So a very, very simple process. The ADP procedure, and I am going to imagine most processors are going to do it this way, will be to debit your full amount and then refund it within 5 business days. And you're kind of probably saying to yourself, oh, that doesn't make a whole lot of sense. The reason they have to do it that way deals with probably the way their systems are built and their internal controls surrounding processing your payroll. And they don't want to break and destroy their whole system that existed prior for many years and will exist going forward many years in the future. Rather, they can just add this step in at the end, and it was a lot easier to build from an IT and internal control perspective. So that's why they do it that way, or at least my assumption of that. Okay, so now, again, told you, payroll tax deferral, very easy. Onto the economic injury disaster loans, the EIDL. So if you've been on some of our prior webinars, you were aware that I very much was on the camp of secure your PPP, put all of your focuses on your PPP, and then worry about your EIDL, because while they said you can do both, and technically you still can, I had concerns they would change the rules on the fly, and you could potentially jeopardize your great program, the PPP, which has the higher benefit, for something with less benefit. They still say you can do both. And just something to keep in mind is they have changed the terms on these EIDL grants already. So it's not like it's out of the realm of question for them to change things on the fly different than what they say might happen. Hence why I had that caution and conservatism when it comes to the EIDLs. But if you have a PPP or you weren't able to get one, this program can be supplemental or helpful otherwise. The EIDLs are the traditional SBA loans often used around times of disasters. Locally, we would have heard them during Hurricane Sandy. You will see them, they had them during the Nashville tornadoes that occurred right before the COVID-19 crisis really hit us. They happen all the time. It is the traditional loan used around disasters. And as I mentioned, it's a separate program from the PPP. Unlike the PPP, there's no federal guarantee. There is an underwriting process, and you will have to pledge both collateral and potentially personal guarantees. So you think about the PPP, in terms of being a loan, it wasn't really that hard of a process. Anybody who's been through a loan process before was almost like, wait, that's it? It was new to us and we had to figure out how to calculate payroll. But other than that, it was a relatively straightforward process. This is a more traditional process with the SBA, collateral and guarantees, and there's no guarantee of you getting this loan. The CARES Act did provide a couple key changes. Number one, these EIDL grants, which were first advertised as a $10,000 grant to be paid within 3 days of applying, As you may or may not know, that didn't happen. They are allowing for what they're calling alternative approval procedures. And from what I've heard from different sources is they are largely pulling the credit reports, a hard pull, of owners, which I found to be a little interesting considering how there's no personal guarantee. I guess they're just trying to say they did something and working their way through it. I don't know 100% what alternative approval procedures mean. I think in the short term, it meant we don't want to go through the typical SBA EIDL process, which was long and burdensome, but trying to find ways to streamline the process. Finally, they got rid of the suspension of the credit elsewhere analysis. Those familiar with the SBA know their MO has always been, if you have credit elsewhere, you can't come to us. Well, they have suspended that, that requirement. So keep that in mind. So what's the current status of the program? The act passed last week had an additional $10 billion in appropriations for grants and another $50 billion for EIDL loans. If you had tried to apply prior to last week, you had gotten notification that there was a lapse in appropriations and the SBA is not taking any more applications. As of yesterday evening, I didn't check this morning, the SBA is still only processing their backlog and has no indication as to when the applications will be reopened. The terms of the EIDL grant have changed. So remember, the EIDL kind of has two components right now. It has this grant, which is a non-payback item up to a certain amount, and then an actual loan, which needs to be paid back. But the EIDL grant, which was under the CARES Act, was a $10,000 grant for all applicants to be paid over within 3 business days of applying. They were flooded with requests, basically nonstop. The SBA has now changed the terms to be a $1,000 per employee grant, including owners up to $10,000. This portion is paid without regard to underwriting, and it does not have to be paid back. Any actual EIDL loan has to be repaid, but the EIDL grant does not need to be repaid. The SBA says that it's usually a 21 to 45-day turnaround under typical EIDL conditions. I anticipate it's going to be longer than that. Think about the sheer number of applications that are applying and the status of that trying to work through the PPP program. My gut says it's going to be somewhere between 75 to 90-day turnarounds. You know, maybe they will surprise us pleasantly, but I think the point I want to highlight is not quick money. The PPP in all relative terms, despite the uncertainty and the stress and people who may have not gotten it yet, is what I would call quick money. This is not going to be that kind of process. Okay, so the loan terms on the EIDL, the Economic Injury Disaster Loans. So the loans are up to a 30-year maturity. Based on my digging into SBA resources, some older ones that have been superseded, but I'm sure they probably still have relevancy. Loans either have a 15 or 30-year maturity. The interest rate is a 3.75% for for-profit organizations, 2.75% for nonprofit organizations. You can, under $25,000, there is no collateral required. Under $200,000 of loan amount, there is no personal guarantee. The first payment is currently deferred for up to 12 months, and there is no cost to apply and no obligation to accept this loan. So again, it is a loan. It is something that has to be repaid, but you have no obligation to take it once you get it. The loan, unlike the PPP loan, can be used for accounts payable, payroll, and for your current portion of any fixed debts you may have. So I want to highlight again, this is a separate program than the PPP. You can technically apply for both. My advice is to make sure you first have your PPP secured, then go for the EIDL, and you cannot use them for the same cost. So you're going to very much want to track what costs you use for your PPP loan proceeds and what costs you use for your EIDL proceeds. You would ideally use your EIDL for non-PPP accounts payable or current portions of fixed debt, or keep those proceeds aside for after your 8-week period of your PPP, and then you can start to use that for payroll. On the EIDL, your ineligible uses include owner distributions, refinancing of any debt, and expansion. So they are less restrictive than the PPP, but still have certain restrictions that you need to take into account. So going on the loan guidelines now, this is how the SBA is basically going to approve these loans and how they're going to size them according to what I've seen and some informal guidance the SBA has put out. So the primary criteria for approval will be the acceptable credit history, and I use quotations, of an applicant, either a Dun & Bradstreet or similar business credit reporting agency. I have heard, and I have now actually seen, based on one of our clients, that it may actually also have a hard pull on a 20% owner's credit report. So if you are wary of or monitor your credit score, note that this will be a hard pull, same as if you applied for a credit card. The ability to repay the loan is determined on a case-by-case basis. So it's not like it's a if then they're going to look at your entire scenario, and I have some guidance that I've seen, again, in older SBA material as to how they kind of get to this stuff. It's not going to be 100% there, but I think it'll help you know kind of what kind of battle you're getting into. The SBA guidelines say that you can get up to $2 million on these EIDL loans. Practically speaking, from what I have seen in experience and what I have seen on SBA guidelines, the loans are being underwritten for between 2 and 6 months of an SBA determined working capital, which I will discuss next. So there, I've heard one person who applied for 600,000 and got, I think, 110,000, and I've heard similar cases to that. Am I on hearsay? Yes, but I did see this particular quote on an SBA from the West Virginia office say this is how they're currently handling the program. So I have it under decent authority that this is going to be how it's going to work. And like I said, this is a loan. The SBA will want to see if you can repay this based on your current debts. It's not like the PPP where there's no repayment. This is a loan, and you're going to have to repay it. So estimating the terms of the EIDLs. The key items that you're going to need, or the key indicators, I should say, are your sales, your cost of goods sold, gross margin, your gross margin percentage, what your monthly net income is, an SBA determined maximum acceptable fixed debt percentage, which is 40% for businesses, and your monthly fixed debt amounts. So the way they first determine your economic injury, depending on the size of your loan, for most people, since they're going to want to be under the $200,000 threshold to avoid any personal guarantee, at least in my experience, it is going to be your normal annual sales, your last 12 months, times your normal gross margin percentage divided by 12 times 4. That's what they determine to be your economic injury on a mathematical basis. For working capital, they take your monthly gross margin, which is your sales less your cost of goods sold, divided by 12 times the number of months they're going to fund you. As I saw on some SBA guidance, there is typically 2 to 6 months. So I'm anticipating 2 months is probably where they're looking at that. When they judge your ability to repay, they're going to look at your monthly net income times 40%, which is your maximum acceptable of fixed debt. They'll take your maximum acceptable fixed debt less any other debt you have and see how much cash you have available for debt service. Again, high level idea as to how they're going to look at these loans. They are underwriting them on a case by case basis, but they want to see basically your gross margin as a very key factor here. And they're going to want to see that you have cash available for debt service, saying that only up to 40% of your net income can be used for debt service. These are SBA guidelines. Going over the application process for these SBA loans, your first step is to fill out the initial SBA streamlined application. It's on their website. It only takes about 10 minutes. It has a multiple choice box to start as to if you are eligible. You put in a few pieces of information we'll cover next. You hit submit and you are done. After you do that, your loan processor or officer from the SBA will have additional requests. I have a sense of what those are going to be. I'll cover those next. Your loan will then be approved, denied, or you'll get a request for more documentations from the loan officer. And then finally, you can accept or decline your loan. So looking at these applications, the initial EIDL application, this is what the SBA says that you should have available. The additional is based on what they used to ask for when you were doing this. The streamlined application may eliminate some of these, but I would be prepared because as we saw on the last EIDL go around, funds are limited. So you'll need to do your initial entity eligibility verification. They give you a multiple choice drop-down box. You have to fit into one of their categories. You'll need your gross revenues for 2019 and your last 12 months, your cost of goods sold for 2019 and your last 12 months, any insurance or other reimbursements you may have received. I cannot find if that does or does not include a PPP. My sense is that I would put my cards on the table because they'll be able to find out either way and say you got a PPP. It may impact your ability to get this EIDL, but you don't want to be lying on loan applications. And if they provide more guidance as to what that means, it normally means business interruption insurance or something of that nature, but it does say other reimbursements as well. The number of employees that you have and your banking information. So that's what you need for the initial EIDL application, not particularly burdensome. For additional items they may ask for further in the process. SBA Form 5 is the official application. SBA Form P019 is a COVID-19 addendum, which asks for pretty much similar information as your initial EIDL verification, 12 months of gross sales and cost of goods. Form 413, which is a personal financial statement for any 20% owner. Form 2202, which is a schedule of liabilities for the business itself. Form 1368, which is a request for financial information, your last 2 years business tax returns, your last 2 years personal tax returns, any balance sheet and profit and loss for 2019, and your year-to-date balance sheet and profit and loss. I haven't heard and I haven't been able to find out how this changes for a nonprofit organization that may be applying, particularly because there are no owners. I would be curious to see how that works, but I just don't have answers to give at this time. We know that private nonprofits are eligible, which based on SBA guidance we find elsewhere to mean nonprofits that are non-governmental are eligible. So I don't know how this guideline and framework is going to fit in because you don't have owners. I take a guess that you'll probably just skip over that step, but I can't say with any real certainty how that will work. Okay, finally, we'll touch on the Main Street lending facility and then take a few minutes for question and answer. So the Main Street lending facility, and I think the word Main Street kind of overblown because these are bigger loans than a typical Main Street firm may actually be looking for. But the Main Street Lending Facility was announced by the Federal Reserve on April 9th, 2020. It had a comment period through April 16th, 2020. One of the comments that repeatedly was made by multiple sources was the participation criteria may be too broad. That being said, too limited. That being said, as of this morning, still haven't seen anything on changes in terms or who is offering these. They're going to be through current lenders like the PPP, but they haven't said a whole lot else about them. I've been hoping to see more, waiting on new criteria, new guidance, but all we have are 2-page term sheets that have a lot of questions, particularly for privately owned organizations. And it isn't clear if a nonprofit can even apply for these. The law says that the CARES Act will strive to create a facility that nonprofits can participate in to the extent practical. Don't really know what that means, but my initial read on these is that nonprofit organizations will not be eligible. The program exists of 2 facilities, the quote unquote new loan facility and the expanded loan facility. The new loan facility is smaller and will allow for organizations that don't have a prior loan with a lender to get a loan up to a certain amount. The expanded loan facility allows for organizations that currently have a line of credit or some other form of lending with a bank to expand their line that exists and has bigger limits and more restrictions, I should say, and more guidelines. The loans will be originated by current lenders. The Federal Reserve will purchase a 95% participation. The bank will keep a 5% participation. What that means is that these loans are backstopped by the Fed nearly fully, but your bank does have some skin in the game. Because the bank has some skin in the game, they're going to subject you to their underwriting criteria. That's why that matters. There are broad eligibility requirements. The 2 biggest meaning you have to be organized in the U.S. and have up to 10,000 employees or 2.5 billion of revenue. So you don't need to have over 10,000, it's up to. So an organization with as few as 1 employee can theoretically apply. Practically speaking, not so much. When we talk about the terms of these facilities, the new loan facility, the smaller one, again, I don't currently have a line of credit, but I wish to get one. They will have a 4-year maturity with a 1-year deferment of interest and principal. The rate will be the stated overnight federal rate, which is currently at 0.01%, so effectively nothing, plus a kicker of 2.5 to 4%, depending on the terms of the loan. The minimum loan amount is for $1 million. And that's why I said I don't know how Main Street this really is, because the maximum loan is going to be $25 million or up to 4 times your EBITDA. Now, as one of the requirements is you have to have at least 4 times EBITDA coverage. So that means to get a minimum loan of $1 million, you need to have 250,000 of EBITDA on your 2019 financials. I don't know how Main Street that really is, but these are the terms of the program as they exist. The origination fees are 1%, meaning you will be charged a 1% fee by the bank. There is also an additional potential 1% fee that may be passed on to borrowers, which, let me translate that from bank terms, will be passed on to borrowers, that can exist as well. The loan period goes through whenever it starts, through September 30th, meaning that's when they will originate these, and there's no prepayment penalty. The expanded facility, again, a 4-year maturity, 1-year interest and principal deferred, same interest rate, same minimum loan. Expanded, though, means you already have an existing line of credit. The maximum on these loans is up to $150 million, 30% of any existing but undrawn debt you may have, or 6 times your EBITDA. So a little bit higher level of EBITDA, but again, it still requires a fair amount of loan. $1 million is a very big loan for many organizations. So I think there's some pressure politically to expand these, lower the minimum loan amount, make the underwriting a little easier. We'll see how it goes. Once again, an origination fee of 1%, originated through September 30, 2020, and has no prepayment penalty. You'll get these from your lender. So if this is a program that you're interested in, reaching out to your banker is the number one thing that you can do right now. The Main Street Lending Facility, the attestations and restrictions. You will not use the new loan to refinance or repay any existing line of credit. So if you want to try to refinance or use it to pay down, that's not going to work. You will, quote unquote, refrain from paying other debts with the exception of any mandatory principal payments you may have. Your lender cannot cancel or reduce any existing lines of credit with the borrower if they want to participate within this. The financing is required because of the exigent circumstances presented by COVID-19 and will make reasonable efforts to retain employees. Not a dissimilar attestation is needed for the PPP. The borrower must attest that you meet the EBITDA levels, and this is where I see a lot of businesses having a potential issue. The borrower will follow the CARES Act rules related to compensation and, more importantly, capital transactions. Compensation means that for any employee making more than a $425,000 a year, their pay is frozen for at least 2 years. And for anybody making more than $3 million per year, they are now subject to restrictions and reductions. Finally, they allow for no capital transactions, which means no dividends, share purchases, or capital distributions. Now, that may be very difficult for small businesses as corporations and LLCs that more or less compensate their owners in that mechanism. I think that's going to be a real difficult barrier for many organizations. Okay, so spend a few minutes on PPP updates, and then we have about 7 or 8 questions. We'll try to take those as well. So on the PPP loan, many of our clients and contacts have received funding. I know many people are still waiting, but more and more daily we're seeing funding go through. Every bank has a system online now. Some are still working more efficient than others. As of this morning, as far as I'm aware, most banks are still not accepting new customers for these loans. There have been additional non-bank lenders approved. Square, PayPal, and Intuit are the big ones, although considering how nervous people are, it's going to run out again. I wouldn't be surprised if those guys are slammed right now. There was an additional $310 billion approved for this program last week that have been restarted as of yesterday morning. Reports were that yesterday afternoon, the SBA system crashed again. The Retail Banking Association has said that this program with this appropriation may be dry by Friday again. So people still need to be vigilant in trying to make sure that if they didn't get in the first time, they get in this time. Still haven't received any new regulations on use or forgiveness yet. Forgiveness is a very popular question. I think there's a lot of uncertainties that we just don't have answers to. And I spent more time on the Treasury website than I ever thought I would in my life trying to see if they come in. Now, some stuff may have come out during the webinar or right as I was getting prepared for this, but still waiting on these forgiveness regulations. And finally, there's new guidance related to the economic necessity component. There was a lot of feedback of publicly traded companies and large companies getting these loans. And as a result, the Treasury last week added a wrinkle to the economic necessity that a business may need to document their need for economic necessity. Further, Secretary Mnuchin this morning or yesterday put out a statement saying that any organization that received more than $2 million in PPP loans will receive a quote unquote full review or full audit of their loan. So that means if you are unsure, I've put some guidelines up here. I want to get to questions, so I'm going to have to cut it quick. But on how you may want to document your economic necessity, taking a look at, again, your general operations background, a discussion of the impact of COVID-19 on your operations, on the general marketplace in your industry, on your key customers and or key suppliers. A discussion of the increased uncertainty in your revenue support, including if you can currently generate, when you anticipate the ability to generate, if you cannot, any declines, any changes in your pipeline, the impact of a second wave or other concerns you may have. A discussion and analysis of your current liquidity and working capital, including any lines of credit you may have undrawn, your ability to access new lines of credit, and or your ability to access potential equity transactions. A discussion of any operational continuity plans that you may have considered, if not for the PPP program, including reductions in headcount and compensation, hiring freezes, changes to your CapEx plans, the use of any prior credit, any updated revenue projections or capital calls, and any operational expenditure cutbacks, changes, or restrictions. And then finally, any other key or organizational threats related to COVID-19. So this new requirement, you know, to someone, it's a common sense item. It's the litmus test I would use is if you're asking, do I really need this? You probably need to document your concerns. You know, if you're a physician practice not currently seeing patients, I think it's a pretty open and shut case. Doesn't mean I wouldn't go around documenting everything and having strong documentation, files, and controls in place over this. But I think that economic necessity concern is less pressing on those versus some other people. You know, we think back to when this first came out, everybody heard free money and kind of just ran into the program as fast as they could. And now the chickens are coming home to roost, so to speak, and people need to consider, did they really need this funding? So that being said, looks like we have a couple questions here. Maybe Ken was able to answer. If I have filed for a PP loan but have not received funding, can I withdraw my PPP application and still be eligible for the ERTC? I would say yes, so long as you have not received the PPP app funding, you should be eligible for the ERTC. They have not specifically answered that question, but it said in the law that any business that received a small business interruption loan, also known as a PPP, is ineligible to claim. They use the word received in there. So I would say if you're pending but unreceived, you should be eligible to claim. Submitted application, can we consider? Okay, same question there. If you receive the PPP loan, when do you pay back the payroll taxes? Yes, so if you defer between the period of your application and when you are forgiven, you have the same repayment guidelines, 50% December 31st, 2021, 50% December 31st, 2022. Can you speak to the EIDL for nonprofits? Terms like cost of goods sold and sales seems geared towards small businesses. As far as I know, and I tried to look into this a little bit, but the SBA is the Small Business Administration. The term sales would basically mean your support, your top line revenue items. Goods sold, I saw on a SBA presentation that they were referring to operating expenses of the nonprofit organization. So I think that is where you could go. I saw that on an SBA slide deck that was for the West Virginia office. Again, really, really helpful one that I found. And they had mentioned that you could use operating expenses. So I would use total support and operating expenses, absent any other guidance that your lender may give during the process. If we have an NOL for 2019 or 2018, can we still apply for the EIDL? you can apply for the EIDL. They're going to want to see an ability to repay. So the NOL is probably pretty strong evidence that you are unable to generate net income to repay it. So it doesn't preclude you from applying, but I think it will present significant difficulties in getting the EIDL. And lastly, Ken Cerini wanted me to point out that East West Bank is currently accepting non-client applications. That's from our last communication with them. So just keep that in mind, that if your bank is not accepting applications, you may be able to work with East West Bank. I think that was all the questions. So if no one has any other questions right now, we'll give you some time back. Oh, look at that one popped up. With the EIDL, is there a way to check the status? We have received an email of receipt, but I've not heard anything since. As far as I know, there is no way to check the status. They're not used to this level of volume, and if you try to call, you'll probably just end up sitting on hold for an hour and a half and getting no answer as a result. So unfortunately, there is no way to check on your status of your EIDL. It basically is kind of a don't call us, we'll call you, which is, you got a PPP loan, is very familiar to how that process worked as well. All right, so I thank everybody very much. I believe you had received a copy of our slide deck prior to this presentation. If not, it's on our website. We will put up a recording of this, assuming there are no other questions. I thank everybody for their time, and have a good rest of your day.